Hello, everyone. My name is Alan Bramson. I'm a CPA and owner of Value Added Accounting Solutions. We are landscaping accounting specialists. Thank you so much for joining me today. Today, we will be talking about the difference between cash flow and profit and the risks of not understanding the difference. So, assume that the financials are fully updated and accurate. The financial reports are all correctly classified. You are reviewing them monthly and you understand them. You're using good information for your estimates for your bids. You are profitable. Suddenly, though, your bank account doesn't seem to reflect this. What went wrong? Now, this presentation assumes a company uses the accrual method of accounting, which a majority of companies use, including many smaller companies. We will discuss in an upcoming presentation the differences between the accrual basis of accounting and a cash basis for the books. Generally, you would expect that the P&L and cash flow should be very similar. I mean, wouldn't they move together, right? Well, unfortunately, this is not always true. A profitable company can have negative cash flow, and on the other hand, a company that has positive cash flow can actually be losing money. A profit and loss statement is a crucial report, one that shows you at a high level if you are earning positive returns on your business. But a P&L is not the same as cash flow. This is why you need to understand the cash flow statement as much as the profit and loss statement. Both are crucial and differ from one another. Now, let's talk about the different scenarios which can cause a difference between the P&L on the accrual basis and on the cash flow statement. The first section you see here are items that do not have to do with a P&L because they're neither income nor are they expenses, but they all involve cash. If you receive a loan or if you're paying a loan back, that's a use of cash, right? But that's not a P&L event. If an owner takes a distribution, same thing. Purchase of equipment. If, let's say, you purchase a truck for $20,000, your balance sheet will show $20,000 less in cash and $20,000 more in a fixed asset for trucks. Now, let's say for your accounts receivable, past monies that your customers owe you from past sales, let's say your receivables began the period at $50,000. Let's say you make a push and you reduce it and collect $20,000 of those receivables to reduce the $50,000 to $30,000. Well, those $20,000 will certainly reduce accounts receivable and it will increase cash. It has nothing to do with the P&L. Same thing in accounts payable. If you owe your vendors money and then you pay some off, you now are spending cash and you're reducing the account payable that will be shown on your balance sheet. Now, in the other direction, there are some items which are expenses or income, but they do not involve cash. This could also create a difference. Depreciation of equipment. Now, previously, we said that we were spending $20,000 in cash to buy a truck, right? So the Truck as an asset, I said, was added to the balance sheet and cash was reduced by an equal amount. Well, that asset will start depreciating on your books. So let's say that depreciates over a 3-year period. So for the next 3 years, you will have a depreciation expense on your books for that truck's depreciation, and it will lower your profit, but it will have nothing to do with cash flow. Let's talk about the recording of bad debt. Before we said that you had collected some of your receivables, so you now only are owed 30. But let's say one of your customers has gone bankrupt and you're pretty much giving up hope to collect, let's say, 10,000 of that. What you would probably do is record a bad debt expense for that 10,000, and you would credit a account on the balance sheet. So bottom line is, this act would cause a reduction of your profit, but it has nothing to do with cash. Now, the last two items are the other flip side of the receivable and the payable discussion we had above. Now, it was true that if you collect old accounts receivable or you pay old accounts payable, yes, that has nothing to do with revenue. However, when you actually are making the sale, the original sale, and the customer doesn't pay you, they are given credit by your company, or the opposite direction. Your company is making a vendor purchase, but you're not paying cash. You're using credit with your vendor. In each case, you have either an income item or an expense that will hit the P&L. But there's no cash impact because you haven't received the funds or paid the funds at this point. Now, the fact that the profit and loss statement won't necessarily follow the cash flow statement can be really significant because, of course, there are great consequences of cash shortages. Depending on the amount and if it's expected or not, cash shortages can be a troublesome issue. It can be catastrophic. If you're not aware that your cash flow will be low and suddenly you may be rushing out to try to find funding for a payday loan for your staff. If you have a vital piece of equipment or if you have to pay for materials, if suddenly you have cash flow problems, that can be a really, really serious issue. Also, you may have property taxes or sales tax payments that you have to make. Well, to make all of this even worse is seasonality is a really big issue in the landscape industry. Companies should be forecasting in a perfect world each month, but certainly frequently, and the cash flow should go at least about 6 months out. This is something that, depending on the service that you have with your accountant or bookkeeper, this is something that you probably should be receiving. Now, let's say that due to a combination of people you're expecting to hire, the potential of a new piece of equipment you were thinking about, and the timing of your seasonality, let's just say that 4 months out, if you forecast, you would see that it's going to be really tight or it's going to actually be negative. You need to act now. You can try to get a line of credit. You can delay adding new staff or equipment at that point and time it a little bit better. You can try to fiddle with the balance between your recurring revenue and your design build. You can bundle different services. You can incentivize early payments. There are a lot of different things that you can do, but the most important one is if you're aware of it, you can try to start planning for it. You do not want to be caught flat-footed and by surprise. Companies fail for many reasons. Sometimes the market is just a poor market at that particular point in time. Perhaps the strategy's poor. Perhaps the product doesn't work or it's not really perceived to be valuable. Perhaps the management team isn't the right team. Sometimes a company may have poor leadership. It could be outcompeted by very strong competitors. There could be a lack of experience. Now, U.S. Bank in a study reported that 82% of business failures were as a result of cash issues. Be careful you are not in this position. Well, that's the presentation for today. I hope that was helpful. As always, let us know if there's any help that you might need for your business. You can find us as usual on YouTube, Facebook, LinkedIn, and on our website. Our website is www.green.valueaddedaccountingsolutions.com. Well, thank you again, and I look forward to seeing you in the next presentation. Take care.